Long-term liabilities are obligations that a company expects to pay more than 1 year in the future. These obligations often are in the form of bonds or long-term notes. This video will focus on the major characteristics of bonds. There are 2 additional videos that will address the accounting for bond transactions. Bonds are a form of interest-bearing notes payable issued by corporations, universities, and governmental agencies. Bonds, like common stock, are sold in small denominations, usually $1,000 or multiples of 1,000. As a result, bonds attract many investors. When a corporation issues bonds, it is borrowing money. The person who buys the bonds, the bondholder, is investing in the bonds. Bonds have different features. We will discuss some commonly issued types of bonds. Secured bonds have specific assets pledged as collateral for the bonds, whereas unsecured bonds are issued against the general credit of the borrower. Large corporations with good credit ratings use unsecured bonds extensively. For example, at one time, DuPont reported more than $2 billion of unsecured bonds outstanding. Bonds that can be converted into common stock at the bondholder's option are convertible bonds. Bonds that the issuing company can redeem or buy back at a stated dollar amount prior to maturity are callable bonds. A bond certificate is issued to the investor to provide evidence of the investor's claim against the company. The bond certificate provides information such as the name of the company, the face value of the bonds, the maturity date, as well as the contractual interest rate. The face value is the amount of principal due at the maturity date. The maturity date is the date that the final payment is due to the investor. And lastly, the contractual interest rate is the rate used to determine the cash interest payment. The contractual rate is often referred to as the stated rate. A bond payable is simply a promise to pay a stream of payments over time, the interest payment, as well as a fixed amount at maturity, the principal. The current market price, or present value, of a bond is the value at which it should sell. Market price is a function of 3 factors that determine present value: the dollar amounts to be received, the length of time, and lastly, the market rate of interest, which is the rate investors demand for loaning funds. The process of finding the present value is referred to as discounting the future amounts. Let's assume this company issues $100,000 of 9% bonds due in 5 years with interest payable annually at the end of the year. The bondholder would receive 2 types of cash payments: the principal of $100,000 to be paid at maturity, and 5 $9,000 interest payments over the term of the bonds. The interest payments of $9,000 was found by taking the principal of $100,000 and multiplying that by 9%, which is the contractual or stated rate. The current market price of a bond is equal to the present value of all the future cash payments. The present value of receiving $100,000 in 5 years is $64,993. And the present value of receiving $9,000 for the next 5 years is $35,007. The price of this bond is $100,000.